Everybody. Just wanted to do this case study, like looking at a deal from scratch, like brand new, like just came across your desk or got a text, whatever, email, and you're like, I don't know if this is a deal. So this is a 10 unit deal that just came across. I don't know how, some type of notification we got on it, but it's just listed on the MLS. It's on Zillow. It's not like hidden. This isn't off market. It's not a special deal. We didn't scour the earth to find it. It just kind of came across uh, my desk, honestly, today. So I'm just checking it out. I figured this would be a good time to show how we analyze whether something is a deal or not for us. And we do multifamily, affordable housing, single family as well. More we're leaning towards like mixed use or having a large master plan development if it's going to include single family. But that's what we do. So we're looking at it from that lens. And it's a little different. So anyway, just check out kind of how we do it and let me know your thoughts and what you do on your end. I'm going to switch through these tabs, so just bear with me as I work with this platform. All right, so we're already on this tab. So this is basically just a very simple back of the napkin spreadsheet that we use to just get a quick idea of what we're looking at. This isn't something that we give to the lender or present to investors or anything like that. This is just to understand what we're dealing with, put the initial information together, and make a decision on whether or not we even want to look at the property. So very early on. So very simple. You got name here, you got address. This is in the Oakland City area, so I'm familiar with 30310. Done a lot of work. That's Southwest Atlanta. For everybody, I think Tyler Perry Studios is like right in that area. Um, they're asking 775. It's 10 units, so it's 77.5 a unit. That's the person selling it. So I already kind of inputted some of this information, but where I got this from, I'm gonna go to another tab now and show you. Share this tab. Great. Okay. So this is the HUD, FMR, small area market rents. Basically, it's what the government comes up with as fair market rents, more so the maximum that they'll give you for programs like Section 8 and any other voucher and government subsidized programs, which is what we specialize in. So this is like the chart we use for our rents. A lot of people that are in real estate that work with market rates won't be familiar with what you're seeing here. They also may think that they're high, but it's the government that's paying it, and we have to remember they're the biggest purchaser of products and services. They have a pretty large budget. So anyway, we have to find the zip code 30310. So almost there. There we go, and that's where we got this amount from. These are studios, one bedroom, 2, 3, 4. As you can see, it goes pretty high. This is a more affluent area, but you still can get a voucher to live in this area. That's a 4 bedroom. So 4 bedroom right now on Section 8 could get up to $4,070. Now that does include utilities typically, so you have to account for that, but still an amazing number either way. But this is the number. This is where I got 1430 from. So we take this number, we go back to our spreadsheet, and we see it right here, which means that's basically how much we got coming in monthly. So this is now our pro forma. It's vacant, so there's no T12. There's nobody there now to run an analysis on, so you don't have to do any of that. We're just looking forward at this point. So we have the pro forma, and based on the 14.3 a month, we're bringing in about 170 a year. We use 40%. For our expenses, depending on the project. Small multifamily, we use 40%. Larger multifamily, we actually go higher in expenses. There's just a little bit more to pay attention to, like security and anyway. So there's more things there, insurance and what have you. But so the NOI we get is about 103. We're using a 6.5 cap rate. Our lenders are underwriting our deals at 6 and 6.25 cap rates, but we like to add a little cushion. And then the interest rate that we're seeing also is below 7, but we're just being conservative here we just want to make the most conservative offer. We want a strong offer, but we want to make sure that our risks are covered because things are crazy right now. But that gives us a value of about 1.584, assuming, and this is upon stabilization, we got the whole place occupied. It's cash flowing, as you can see. Well, we haven't seen that yet from the debt, but that's what we're going to now. So our target DSCR, which is just the amount of money you want to make over the loan payment, that is 125. That's pretty standard in the industry for any type of project, even affordable or not. It's pretty standard to be 1.25. Affordable projects actually go down to about 115, 118, depending on who you're working with. But we still stick to the 125 because once again, we want our offer to be strong. And then that gives us max debt service of 82,000 if we go by that. So that means the max loan that we want to take out to do this project is 1.1, which I don't think that we'll get above. So my point is, it looks like debt can actually fund this entire project without a need for equity and still hit our target debt service coverage ratio. So let's just say we pay asking price. Probably won't. Let's just say that we do. That's what you see here. Acquisition hard costs. We're putting in 25,000 a unit. Now let me pull the project because I want you guys to see the condition. Just give me a second. I'm just going on Zillow right now. So it does need some work, but I just want you guys to see that it's like standing. Here we go. Okay, so it's standing. We don't know where it doesn't seem like it's not a tear down or a rebuild or anything like that. It seems like it's an official rehab. Now, a strong rehab, a substantial rehab, but doesn't look like it's a tear down and you need to rebuild like from the studs or anything. So that's an assumption. We don't know until we see it. As you can see here, they even estimated rehab cost at 10 to 20K a unit. We're saying 25. So anyway, and this isn't true. This is Section 8 maximum payment is 1854.11, but we just saw that list, so that's not true. But either way, it is what it is. But so these pictures here, as you can see, decent. Still have windows, still have the doors. All this stuff will need to be replaced, but I think within $25,000 we could do a lot of that. I mean, everything's coming out from the looks like most likely the drywall, but these window units got to put in HVAC, these doors, everything has to go. So it's going to be a complete facelift, but the bones exist, I guess, is the point that I'm making. We'd redo the roof. This would be a complete rehab. Oh wow, here's a different one. This is old. This is from 2021. But either way, so just wanted you guys to see where I'm getting this information from. And let me get back to there we go. So we're gonna put 25,000 in each. These are soft costs, which just little costs that you have while you're acquiring a property, just things that just different fees and such. The lender, it's a lot of different things you got to pay for, due diligence, appraisal, this, that, whatever. And then we have the finance costs. Those are the fees actually from the lender. So the total project costs are about 1.056 million, and which comes out to about 106, a little under 106 a unit, which is pretty good. We try to stay under 150 a unit. Right now it's hard in this market, but that's pretty good, especially from small multifamily, which brings our project LTV to 67%, versus its potential value upon stabilization is what that means. So we're going to spend less than 1.1, and then we're going to get a value of almost 1.6. So that's pretty good. Our goal here is to stay under 80. So obviously we're winning there. We're assuming here that we get a loan. We get 10% loan to cost, which means our loan will cover 90% of the cost of the 1.1 0.05, and then the rest we'll have to bring in cash or through an investor. I think we try to figure that one out ourselves so that we don't have to have a partner on the project since it's kind of small. Our debt service, and this is our debt service is here, almost 67,000 a year. So our cash flow is 36,000 a year, which gives us a pretty good cash yield on our investment right here. We put out 36, we bring in 10. I mean, we put out 105, we bring in 36. My bad, and that's the cash yield. But that's annually, so we would expect that, or possibly more next year, assuming everything goes well. And within that 40% of expenses, we have a lot of room for contingencies, and then you have your gross operating income coming in that you service the property with. And DSCR, as mentioned before, we have the 125 target. We would be doing much better than that. So this looks like a pretty strong deal. Don't know a lot about it. Don't know if it needs more than 25,000 a unit. It may. So my point is, we do these just to see if we'd even be interested in having a follow-up conversation with the owner or the broker or whoever. So that's kind of what we're looking like here. So yeah, this is actually a pretty decent deal. This is just kind of a breakdown of if we did bring on a co-developer, what that would look like, where we own the majority of it and bring them in as a minority partner to help with the project. And this just allows us to do more projects and bring in expertise and extra capacity to get them done. But even with bringing in a co-developer and giving them 40% of the project, we'd still be looking at a pretty good return on our 106 or 105. So anyway, that's a quick rundown of how we look at deals just before we go take a look at them and go a deeper dive into them. So let me know what you guys think. If you guys, how you guys underwrite your deals, or see if you're, what do you do when you're interested, or when something comes across your desk, across your table, and, you just want to see if it's something that you want to take down. I appreciate you checking us out, and make sure you comment, like, subscribe, all that good stuff to help us understand how to create more content like this. All right, bye guys.